Is the 60-40 portfolio dead? Where will interest rates be in 12 months? Is inflation back? Will corporate earnings grow this year and by how much? These are the types of questions we get asked a lot.
And the honest answer to most of them is it's complicated. But that is exactly what we're here to discuss.
I'm Richard Flax, Chief Investment Officer at MoneyFarm. I've been managing portfolios for 20 years through rate cycles, political shocks, and liquidity crises.
And I'm Jack Amy, Quantitative Trading Analyst, and I sit on the Investment Committee. I spend most of my time watching markets and thinking about the market structure questions that impact our clients' portfolios.
This is MoneyFarm, a matter of interest. And yes, the pun is intended. We'll be talking about central banks and interest rates, sure, but more importantly, we're focusing on the market events that actually matter for your money, and hopefully that interest you.
Every 2 weeks, we'll look at what's moving markets, a macro event, a policy shift, a jump in volatility, or a drop in prices, and we work through it. What's driving it and how we're thinking about it at the investment committee level and what it might mean for our portfolios.
We're not going to pretend we have all the answers. Nobody does. But we do have a process, and between the two of us, a view, sometimes from both ends of the spectrum.
Richard is mostly thinking about the longer-term consequences of what we're discussing. While I find that fascinating, a big part of my day job is to translate those events into actually facing the market and trading. What's relevant over the next few hours may not matter in 3 months.
Sometimes we agree, sometimes we don't. And that's usually when it gets interesting.
So whether you're a client, you work in markets, or you just want to understand what on earth happened to your portfolio last week, hopefully there's something here for you.
Every 2 weeks, wherever you get your podcasts.
Please remember that when investing, your capital is at risk. The views expressed here should not be taken as a recommendation, advice, or forecast. If you are unsure investing is the right choice for you, please seek financial advice. So, welcome to the first episode of A Matter of Interest by MoneyFarm. In this first episode, we're going to be discussing SpaceX and then have a quick checkup on what's going on in the general macroeconomic environment. But starting off with SpaceX, Richard, just on the headline level, how did it go on Friday after its IPO?
Yeah, so I think in the end, it went pretty well. The book was well covered. You saw a good amount of demand in secondary trading. The stock popped, I guess, around 20% at the end of by the time that it closed. You know, a sort of sensible outcome, at least on the day from an IPO perspective. And so I think the book runners and the syndicate are probably relatively happy with how things went. That, as far as I could tell, there were no sort of operational issues. It all seemed to go fairly smoothly on our platform. Also, the trading seemed to be fairly smooth as well. So overall, I think, on a one-day view, and it is only a one-day view, a pretty successful outcome from what has been, the largest IPO in history.
Yes, so kind of a lot of noise around this IPO, generally spoken about to be sort of 4 times oversubscribed with some really, really large numbers in terms of target allocations that wealth or asset managers were giving out. But if we take a step back, obviously the market managed to digest the IPO. There was a lot of trading. The stock went up. More broadly on tech stocks, US stocks or AI stocks, what does it tell us that they managed to pull the IPO off and they managed to get the stock to pop and that there was such high demand for trading in SpaceX and particularly kind of retail investors accessing that stock?
Yeah, so look, I think there's a few moving parts here. I mean, I guess the first part is that it was a very large offering, right? And so you needed to be comfortable that you were actually going to see demand for it, and that investors were going to have the kind of dry powder to actually digest a multi-billion dollar offering. The second part was that this question around valuation. Obviously, the stock was priced according to some metrics at 100 times revenue, which is a pretty punchy number. It's not a profitable business, so you can't really talk about earnings in that context. It's also a business that, looking at recent historical data, is not growing super fast. It's growing comfortably double digits, but not faster than that, at least for now. And the big selling point was, well, a couple of things, right? In my mind, right. One was the total addressable market point that they made, and they said between the LLM and the artificial intelligence piece and the satellite piece, there was significant underlying demand, a really big market share that they thought they could go after over the in the coming years. And the second part, obviously, is I think the sort of Elon Musk effect of somebody who's repeatedly gone against the odds, has built businesses that have been very successful, has thought very, very large in terms of the goals that he has for himself and for his businesses, and there is a meaningful amount of support for him as a result, and people who somehow don't really want to bet against him. And so there were these moving parts, and all of that sort of coalesced around what I think, at least again on that one-day view, was a pretty successful offering.
Definitely. And then in terms of deconstructing that, how much just roughly do you think is retail mania? How much is another kind of interesting point, which is just how quickly SpaceX will enter some major indexes and the forced buying that will be caused by that? Do you have any view on whether it's sentiment-based, whether it's almost the market structure forcing investors in, or is it broadly the market being in a place where an IPO like this with such a high valuation is the market, it finds it more palatable?
Yeah. So look, I think that there is a bit of an alliance here between retail investors and index buying, and you can say that is that good or bad? That's something a little bit to unpick. Our understanding is that retail investors were allocated a reasonably large percentage of the deal. That isn't the case in all IPOs by any means, and I think it's a reflection of some of the sentiment, positive sentiment around Musk and around the business. But there are a couple of moving parts here. Over the last few years, obviously, we've seen the sort of the meme stocks and the extent to which retail investors have driven that. You've seen, particularly post-COVID, increased appetite for DIY investing. Not just in single stocks, but obviously in options volumes as well. And you really see that in the US in terms of the options volume. And so retail investors are, it seems to me at least, becoming more and more of a driver, more and more of a setter of prices. And, the other part of that is, as you say, this is a large stock with a relatively small free float. And you've seen some indices, like, for instance, NASDAQ, or MSCI, where this stock will be included relatively quickly, by which I mean weeks. Not at a particularly big weight, but there is a good amount of index.
But still a meaningful one. So to put some numbers on at least the NASDAQ 100 inclusion for SpaceX, the various rules, which, as you say, one will be included after 15 days. The second one is that for stocks that list less than 30% of the free float, the index weighting or the market cap is tripled. So you're going to end up with roughly 1% of the NASDAQ 100 buying into SpaceX on day 15. So sort of 3 trading weeks, as I understand it, after the IPO. So there will be a lot of demand for this. And for a rough number, you've got something in the order of 600 billion tracking the NASDAQ 100. And then a great number after that of investors who are benchmarked to it. So therefore have to make a choice whether they want to include it in their portfolios or have an active bet against it.
Yes. And I mean, it's worth highlighting that S&P have historically had stricter criteria and have not relaxed those criteria. They have a seasoning period of 12 months, and you have some profitability requirements there as well that at this point at least SpaceX won't meet. And that obviously has implications for us when we think about how to construct portfolios and what exposures we're really taking. But I think it's, I have sympathy with the S&P view that I guess collectively they decided they weren't going to adjust their criteria for this. And there's this tension between you have criteria, you should stick to them, versus, there are a bunch of potentially very large companies coming to the market that are very impactful in terms of potentially the global economy. And so you as an investor would like to get access to those. It is a bit of a tension. I'm a little bit more aligned with S&P's slightly more conservative tack on this. But it's a discussion that I think will continue to happen over the coming months.
Which is certainly interesting, but to make the other point, and I'm not necessarily sure I fall on either side, but you could argue that passive investing in its purest form is buying the market. And with SpaceX and many of the tech companies, which we'll probably mention in a couple of moments, coming to be public companies so late, they are a larger and larger portion of the market, and therefore not having them in the index means that you're not truly following the sort of pure passive play, because you are not including those very, very large companies in your portfolio.
No, I think that's fair. Look, I also think, these are businesses that are not listing a huge amount of their free float. These are not criteria that have been created for this particular scenario or for 2026. They've been in place for a while. And, Tesla had similar issues when it listed and it didn't fulfill some of those S&P criteria. It took years before it came in. And So I think that the market, the indices can survive this particular experience. I don't think it's a huge issue, but it is something we'll continue to keep an eye on.
Switching topic slightly to not the IPOs that we've just had, or the IPO that we've just had, but the IPOs that are coming up. Do you think this gives us much insight into how the market might take an Anthropic or an OpenAI listing?
Look, I think it does a bit, and I think it does a bit because if you take the counterfactual, what if the SpaceX IPO had gone really badly and the stock had fallen on the first day? In that scenario, would that have told us something about concrete about investor appetite for large new listings of unprofitable businesses? And we would probably have said yes. So the mirror image of that is that the IPO has gone, we think, fairly well. We know that there is more to come. And so you would infer that investor sentiment and investor appetite for these types of businesses is there, and at this point at least is undiminished.
More broadly, the question here is kind of, can the equity market, which has been generally kind of seeing less and less issuance over the past 10 or plus years, do you think that the equity market is in a place, particularly in the US, where it now can be used for either new companies like the three that we've mentioned, or companies like Meta or Google, to come in and issue equity, to allow them to build out this continued investment in AI?
I think the answer here is pretty clearly yes. We've seen the SpaceX IPO, but we've also seen capital raises from a number of large tech businesses in the equity market to fund out this very significant capital investment that's required for artificial intelligence, be it data centers, whatever it happens to be. And so the equity market is clearly open for these types of businesses. As you say, what we have seen in recent years is companies staying out of the public market and staying private for longer, partly because there is a lot more private capital around. The private capital markets have developed significantly and are providing multiple rounds, are providing liquidity for founders and employees potentially. And so the desire to go public with some a number of onerous requirements, relatively speaking, in terms of reporting and in terms of fiduciary responsibility, that is relevant. Is that a bad thing? That companies kind of come to market maybe at a slightly more mature phase? I don't think it is necessarily. You can say yes, you've missed out on some great growth, but there are a lot of companies that perhaps fall by the wayside, that if we go back to the kind of .com experience in the 99 and 2000, companies that perhaps shouldn't have listed that did list, that largely disappeared 2 or 3 years later. So I see them coming a bit later, or we see them coming a bit later. I'm not sure that that's such a bad thing.
And then last, probably the most difficult question, given all that and what we've discussed, is it AI or bust for the equity market? And if it is AI or bust, how do these companies need to perform in order for us to see kind of continued positive performance from particularly US equities over the next 12 months?
Yeah, I always hesitate to say it's anything or bust, right? So is it AI bust? Look, AI is clear as a significant driver of equity markets at the moment, a significant driver of US GDP growth. If you think about what proportion of it seems to be tied back to data center spending or capex like that. So I think it is very significant. If we look at earnings, though, or earnings revisions, the earnings revisions, which are being raised, right, as a sign of relative confidence, that's pretty broad based. It's not necessarily purely focused on tech or on AI. But I think that this is a meaningful driver of growth. It seems to be a driver of earnings and potentially a driver of employment, even for households as well. Obviously, a big debate about what happens to jobs kind of longer term. But, for at the moment, you need people to build these data centers at a very kind of crude level. And the labor market seems in pretty decent shape in the US from the latest report. So, for now, AI is a pretty meaningful driver. But the impact that we see is still fairly broad-based.
So a much more positive read.
Before we continue, a quick note about MoneyFarm. We're a digital wealth manager with a simple purpose: to combine passion, expertise, and technology to give clients the 3 building blocks of investment success: access, advice, and low cost. Today, we help people manage their wealth through investment portfolios, pensions, ISAs, cash savings, and self-directed investing, all accessible through our platform and app. Whether you prefer to make your own investment decisions or receive expert guidance, our services are designed to support you at every stage of your financial journey. Alongside our team of investment experts, clients can also access Bastion, our AI-powered agent, which provides personalized insights and clear, accessible guidance to help them make more confident financial decisions. As always, remember that investing involves risk. The value of investments can fall as well as rise, and you may get back less than you invest. The views expressed in this podcast should not be taken as advice. Now, back to the conversation.
So switching topics just for a kind of headline look at where we are more broadly, I think we have a good opportunity to relook at US macro now that Kevin Walsh is coming in to lead the Federal Reserve, and we'll probably have public statements from him this week. We're recording this on June the 15th. So where are we in the US with inflation, with rate expectations, and kind of in the UK and the Eurozone as well?
Yeah, so let's I guess start with the geopolitics of the thing, right? Which is that we've, obviously you've had an energy price shock of, oil prices kind of touching $100 a barrel at some point or above, compared to where they were at the end of February. We've heard over the weekend that the Straits of Hormuz have now been reopened. We think there seems to be some agreement between Iran and the US that is the case, which hasn't necessarily been the case over the last few weeks. And so we've seen oil prices kind of come down, and this matters because inflation, in developed markets generally is running somewhere above where central banks would like it to be. Remember, central banks typically like inflation at around 2%. A year on whatever metric they choose to measure, and US inflation is running at around somewhere a little bit over 4%. And that is meaningful. And so at the start of the year, and the picture, I should say, in the UK and the Eurozone is similar. And you've seen this pickup of inflation over the last couple of months, really driven by energy prices. And so if you were optimistic at the start of the year, you hoped that perhaps interest rates had room to come down, policy rates. And today you don't have that expectation necessarily, or you haven't. You've seen the ECB raise rates. You've seen at some point expectations for the Bank of England that the Bank of England would raise rates, up to 3 or 4 times. And some of those expectations are now beginning to come out of financial markets, really in the hope that with the Straits of Hormuz reopened and that they reopen on a sustained basis, that energy prices will begin to drift lower, even though, even in that more optimistic scenario, it will take some months before energy supply really gets back to where we were kind of at the end of February.
And on top of the 4 months that we've already suffered of sort of minimal exports coming out of that part of the world. So what does that mean if you're Kevin Walsh? Kind of what cards have you been dealt? If you've got higher than expected inflation, you maybe were elected in a world where people thought you might be able to cut rates, and now you're expected to hike them or do nothing. Is this a more difficult first kind of couple of months than maybe Jerome Powell had, outside of the more personal attacks that came to happen to Jerome Powell? But in terms of the macroeconomic scenario, does Kevin Walsh have it harder or easier than Jerome Powell?
I think Kevin Walsh has there are a couple of complexities, right? Obviously, he has a president who is keen for interest rates to come down. He has an inflation rate that's running at above 4%. There's a good amount of kind of volatility from a geopolitical perspective that's feeding into that. I don't think it's the hardest of hands to play necessarily, if you took away the sort of the political pressure that might be brought to bear. Because I think if you believe that that oil prices can drift lower, and you're comfortable that higher energy prices are not going to feed into broader inflationary pressures, then possibly the right answer is not to do very much, which is more or less where financial markets are at this point. Again, I think there's a bit of a challenge for him in that the labor market is in pretty good shape. Inflation is a bit high, but that can wind out over the coming 6 months. I think the challenge, at least as we understand it, is that Walsh has a view, at least as it's been reported, that AI and AI spending will be a meaningful deflationary force in the future, and that will allow us to allow the central banks to bring interest rates to a lower level than they were. It's a reasonable argument. It's tough to know one way or another, but where I guess I come out on this is that at the moment, at least, there's a meaningful amount of spending, there's a meaningful amount of demand for construction materials, for construction, for land, for permitting, for energy supply, and all of that needs to be built out. And so the initial potential implications might be more inflationary than deflationary. So at the end of the day, I think he faces a challenge because that long-term thesis might well be right, but I'm not sure that's what's going to happen in the short term. And so his ability to bring interest rates down, or for the Fed to bring interest rates down, obviously he's not the final arbiter of these things. It's a vote. Might prove to be just a bit more challenged than you might have hoped. I don't think the macro is in terrible shape. Obviously, they've got the supply shock from the Middle East to deal with, but it's a typical central banker's challenge in that respect, I think.
And to pick up on something you mentioned earlier in terms of there may or may not be an assumption that kind of food and energy prices will come down now and you won't see a meaningful bout of inflation because of what's happened in Iran and in the Middle East. Do you think that's a fair assumption? Do you think we might be missing some of the more longer term inflationary consequences of the crisis that we've had in the Middle East?
Look, I think it's possible. I think it is, and I think it's possible for a couple of reasons. Firstly, you've already had 4 months of higher oil prices. You can say that oil prices have come down from $100 a barrel. They're still up from wherever they were, 60 odd at the start of this, and that has an impact. Fertilizer is, it's about price and about availability at this point, and that needs to kind of to normalize. And the other part is that, look, central bankers look at, inflation that somehow they think they can control, which is on the demand side, right? Supply side, they look past and say, well, there's not actually much that we can necessarily do about that. And that's fine from a financial markets perspective, but it doesn't necessarily address the issue that households face, right? Which is that the cost to fill up my car has gone up. The cost of, food in the supermarket has gone up. And you can tell me that that's headline and it's not core, but I don't really care. It's still money out of my pocket. Yeah. And so, central banker might say, well, there's not much I can do about that, and so I'm not going to make a change to interest rate policy. No, that's fine, but it doesn't, distract from the fact that that households have a tougher time as a result.
Great. And then in terms of what we might expect from Walsh in terms of his activity and his voting pattern, you mentioned earlier that we were kind of maybe even thinking he might cut rates and that we've been in a bit of a flux between hiking and doing nothing. Do you think that he will cut? Do you think, kind of maybe more interestingly, that he will be in a public disagreement with other voting members of the Fed over interest rate policy, maybe to align himself more with the wills of Trump, who's kind of known to want lower rates?
Yeah, look, let's take a sort of, a more optimistic tone and say, look, Walsh is, from what we know, has been a Fed governor before. I believe, is in favor of Fed independence, central bank independence. Clearly has will have a set of assumptions and is a kind of an experienced individual, so have a set of assumptions about how he thinks monetary policy should go. We'll see relatively soon kind of where he comes out. I think with inflation above 4%, even if you think it's going to drift lower, it's tough to see him necessarily voting for a cut on day one, but he might. I think the Federal Reserve, there are disagreements between Fed governors. Obviously, the chair is usually builds a majority around their view, and so I guess it would be unusual or unprecedented for a Fed governor to be in a minority, for the Fed chair to be in a minority in terms, and I think that they will kind of manage their way around that. For now, there probably isn't a really strong case to cut it. Maybe at least one Fed governor probably will be in favor of cutting, as he has been all the way along. But it doesn't seem like that there'll be a majority in favor of it. And that's what's priced in by the markets. I don't think that's a controversial view. Walsh obviously has other kind of plans and focuses of attention. One is around the Fed balance sheet and what he does with that. The other is around how much the Fed speaks, how much information it gives. And I believe he has a view that says that, the Fed is perhaps giving out too much information. And this is a bit of a trend that we're seeing, particularly in the US, around, should you continue to do quarterly earnings reports for companies? Should the Fed, give quite as much information? Fed gives an awful lot of detail, more so in my view than other central banks do. And the question is, does that make it tougher for investors or for markets? The jury is a little bit out, right? Yes, greater, clear, transparent, and accurate information is vital. How is it vital to have quarterly information for companies? I mean, it's helpful, but does it? Can you prove that it changes the it changes valuations, or it changes the way that information is digested? It's much less clear. So we like quarterly earnings because it gives us more information, but I'm not sure that it necessarily delivers a better out. It can be proven to have delivered a better outcome. So it's something that we'll probably hear more from Walsh in the coming kind of weeks and months. But the Fed potentially will perhaps say a little bit less than it has done, and that might provide greater clarity.
Great. Well, thank you very much, and thank you everybody for listening.
Yeah, so that's all we're going to touch on today. That's all we've got time for. Thank you very much for listening, and look forward to speaking with you again soon.